Okay. Like we did the usual. Normally, I want to give a little bit of recap of what we discussed last session, and then we'll continue about today's session. So this is the data we are going to cover in the class. This is data we're going to cover in the class. We talk about the income statement analytics. So how exactly we analyze the quality of earnings, how exactly we can analyze the whether sales contract can recurring in the future or not. What's the likelihood of a sales contract can recur in the future? So we talk about this income statement analytics, and you guys have a project on this, and that's one thing we have done in the past. And for the balance sheet analytics, I just want to recap what we talked about on Monday. So we talk about one firm's experience extreme asset growth. That signals the manager is doing empire building. The manager is using shareholders' money to expanding the firm to increase his or her own control. This is a typical agency problem because the manager's money is not the shareholders' money is not the manager's money. Managers have the control. Shareholders has ownership. So managers using the shareholders' money to bet on his own expansion, growth. So that's why we see it in the future. When the firm has extremely asset growth, we will see a negative future performance. That's what we discussed last on Monday. When the firm experience extreme asset growth, there will be negative performance and stock returns in the future following the asset growth. And we talk about something new. We talk about different ways to analyze balance sheet analytics. One way we talk about is we have to distinguish good growth with bad growth. So the way we do that is when asset growth is financed by equity, bank loan, or bond market, is bad growth, because the managers, they can easily get money from them for their abusing the cash flow for empire building. But we also talk about the good growth. Good growth is if the asset growth is financed by suppliers and vendors, we think they are good growth. We talk about the reasons. The reason is because vendors and the suppliers, they know the firm in a very natural way. It's like they are your friends. Your friends know you in a very natural way. So suppliers and the vendors have authentic information about the firm. If the firm is doing something bad growth, suppliers and vendors will not willing to finance them. So in other words, the metaphor I give you guys is, so let's say Yining, if I want to borrow some money from Yining, Yining know me because we are in the class, right? She knows me, she knows my style. If I'm using the money to do something bad, Yining will not lend me money for that because she knows me from this natural class. And so that's why the vendors and the suppliers, they have more information about the banks and the investors, because when bank and investors trying to get information from the firm can always present the good side of the image and hide the negative stuff. So that's one reason we were talking about why supplier and the vendor financing, they are good. They are good. And we also say that suppliers, they cannot afford later payments. Bank can afford later payments because bank is huge. There's one or two later payments is fine, but the supplier vendors, they cannot afford the later payments. So for all these reasons, the bottom line is, if vendors are willing to finance in the firm's growth, that means this is good growth. If vendors are not willing to finance the good growth, something is wrong. Something's wrong. It's like when Yining willing to lend me the money for my business. This is good. This is good. That signals Yining knows me well, and when she's willing to do so, I'm doing something good. I'm doing some good business plan. If I borrow money from my credit card, something may be wrong. I'm using the credit card to buy something useless or something, you know, yeah, it is not have high return on assets, and it's easy to borrow by a credit card compared to borrowing from the e-link. So that's the stuff we talked about last session, and we also talk about different tests. So just want to a little bit recap. And you guys were talking about we do the ROA and the returns together. I explained why we do the 2x2 sorting. You guys can review what is 2x2 sorting, and you guys, we do the short window to read out the risk, and we do the 2x2, and you guys ask great questions. Why they not add up together? So all these are good discussions we had last section. So today, what we are going to do is we are going to dive into the details. How exactly we calculate the asset growth financed by vendors and suppliers? How exactly we can calculate that? You guys remember last session, I show you guys 250 different variables from balance sheet and income statements. So it's there's a huge volume of variables available there. So today, let's explaining how exactly we use these 250 variables or part of them to calculate asset growth financed by vendors and suppliers. How exactly we do that? So you guys can find a formula in the paper. The formula in the paper, you can see that. Today we are focused on intuition. Like, you can follow the formula easily, but we want to understand the formula, understand the intuition. So this is the first thing we want to do. We want to discuss how exactly we can calculate the asset growth financed by vendors and suppliers. And I want you guys not just memorize the formula. I want you guys understand the formula. That's what we are going to discuss for the following a couple of minutes. So let's look at the formula here. You guys see the screen well? You guys see a screen? Okay. So let's look at this. Let me make it smaller. So operating growth is basically asset growth financed by vendors and suppliers. That's the same thing. Just we label as operating growth. So let's see how we actually understand the calculation of the asset growth. Basically, how you understand the 250 variables and use that to construct the signal which can predict the future stock returns. So asset growth is equal to two stuff. Asset growth is equal to growth financed by vendors and suppliers, and also growth financed by debt, equity, and the bank loan. So you can first break down the growth into growth. Let's say growth. You can break down growth not financed by debt, equity, and the bank loan, and growth financed by the debt, equity, and the bank loan. So that's added together. That's asset growth. Okay, that's step one, right? We break down the asset growth into growth financed by debt and equity, and the growth not financed by debt and equity. That's step one. Okay, let's do step two. Step two is among the non-financing growth. Among these, we further broke down. We further broke down three things. The first, operating growth. That's the asset growth financed by vendors and suppliers. That's what we need. We also have the growth financed by accounts payables, and we also have the growth financed by tax liabilities. So let's understand these three components together. What does these three mean? What does three mean is when company growing, when companies experience growing, when it's not financed by debt and equity, it can be financed by the three sources. One is financed by vendor and suppliers. That's what we want, right? And another thing is it can be financed by the accounts payables, and also it can be financed by the tax liabilities. So it can be financed by the three stuff. So why we want to take out, we deduct the accounts payable finance and tax liability finance from the equation. Let's discuss the intuition. Let's discuss the intuition behind the measurement. So why we want to take out the accounts payable liability. So what's accounts payable for? Accounts payable normally is the payment, the credit on inventories. So in other words, when a company trying to get financing from suppliers and vendors, there are two types of financing. One is short-term assets, like inventories. Inventories is like a very short-term assets. Another one is long-term assets, like buildings, equipment, like huge assets. So here, we only retain supplier financing about the long-term assets. We kind of take out supplier finance about the short-term assets, like a inventory financing. The reason is because we think the short-term asset financing, suppliers do not put too much consideration into it. It's a very small amount. It's more of a routine contract. They don't take it too serious. For suppliers, do not take it too serious when they trying to finance the inventories. However, when vendors and suppliers, they finance buildings, equipment, this big stuff, they are more serious about it. Like the reason I'm talking about, the amount is huge. They cannot afford the later payments. So that's why we take out the short-term financing from the suppliers and vendors. We only keep the long-term financing from supplier and financing. That's why we want to take out the signal in. That's the theory. And also why we don't want a tax liability. Tax liability means what? Means the government allow you to pay tax in a late fashion. So basically, the company, the government kind of allow you to make a late payment on tax or give you tax credit. That's tax liability. That's not clear, because why some firms don't want to pay tax in advance? Maybe the company is doing well, maybe the company is doing very bad. So the story is not clear. Why the government want to financing the firm and allow the firm to make a late tax payments? It's not clear, because it may be a good thing. Maybe the government think wow, the firm is doing well, so you can pay tax late. Maybe that's the good story. Maybe the firm have like a bad cash flow, they cannot make tax payment. So that's why when we calculate the asset growth by vendors, we take out two components. If it's a short-term assets from the if it's inventory, if it's short-term financing from vendors, we take it out. If it's financing from government regarding tax payment, we take it out. So that's the story we have. Some of you may wonder, ask me, hey, professor, what you said may be correct. What all you said makes sense. You want to take out the short-term financing from suppliers because you believe short-term financing is not a serious deal for suppliers. Long-term financing, it's more expensive, it's a huge amount, so suppliers will put more evaluation on long-term assets, and it sounds make sense. And also for the government, when government allow the tax financing or not tax financing, it's not clear. So you may agree with me, the theory wise, it may make sense, but you may also question me, how do I know it for sure? Like how do I know this is exactly what is happening? So my answer is, if you are not sure about theory, you need to test it. You need to test it. So in other words, you can test whether the operating growth can predict the future stock returns. You can also test without taking out the two components. Do they also predict future stock returns? If my theory is right, you will see that the operating growth will predict stronger future stock returns. If my theory is wrong, then you don't take them. You can still, without taking out the two components, you can still predict the future stock returns. So what I'm trying to say here is, we have to, data speaks themselves. We have to data speak themselves. First, you have the theory first. My theory is short-term financing, not good. Government financing about tax, not good. This is my theory. Then, if you don't trust my theory, you test it. So how do you test it? You take them out to see whether operating growth predicts future returns. And then you don't take them out to see if the together component predicts future returns. If taking them out can help you to predict future stock returns, my theory is correct. If without taking them out, you can predict future stock returns, then something wrong with my theory. So that's how exactly you guys can think about the project you guys are going to do. By the end of the semester, you guys have to come up with your own trading strategy. You guys have to come up with your way to analyze the income statement, the balance sheet, the cash flow, blah, 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 all the data we talk about. So you come up with a theory first, and then you test it. How exactly we test it? So that's the way I was talking about, right? So I have the theory that short-term financing from suppliers, no good. Tax financing, not good. And you can test it. If I'm wrong, you see the results against your hypothesis and theory. So this is the formula we have. This is the formula we have here, and so let's see what we have here. So operating growth, it's growth financed by vendors and suppliers. How do you calculate that? We use total asset growth minus growth financed by debt and equity, and minus by short-term financing, minus the tax financing, and then take the difference between everything. We will have the growth financed by the vendors and the suppliers for long-term assets. Let me repeat it one more time. Okay, let me repeat one more time. So we start with total asset growth. We start with total asset growth. We minus growth financed by debt and equity. We minus growth financed by vendor short-term financing. We minus by tax financing from government. We financing everything. We minus all this out. What's the left? The left is exactly growth financed by vendors and the suppliers for the long-term assets. So that's how we do the calculations. That's how we do that calculation. Like I said, when you read the paper, you can get the formula. You can get the formula. But I want you guys to understand the intuition behind the formula, how we come up with the formula. You should understand that we have 250 variables from complex data and the income statement. I hope you guys can understand how to use that to construct a useful signal to predict the future stock returns. Okay, and there's some measurement error. There's some measurement error on this calculation because when we do this formula, there's a chance that the operating growth from the formula may contain something else we don't know. So there's maybe some noise component in the operating growth. So we did something in the paper. We're trying to validate our calculation is right. So how do we validate that? The way we validate is we want to see the operating growth is positively correlated with customer and supplier growth. So the idea here is, if the operating growth calculation is correct, if the firm has a new customer, we should see the growth financed by customers should rise as well. So there must be a positive correlation between new customers and the growth financed by customers. So that's how we validate that. That's how we validate that. So in other words, we worry about operating growth. The calculation of operating growth have some noise components, which will kind of make calculation inaccurate. So we want to validate that our calculation is correct. The way we calculate it is we want to see that when a firm has a new customer, would growth financed by suppliers and customers, would that be actually increased? Will that be increased corresponding to when the firm has a new customer? So we want to see there's a positive correlation between firm has a new customer and the asset growth financed by customers. And do the same thing when the firm has a new suppliers. We want to see that the measure we calculated also increase with the firm having a new suppliers. So this is how we validate this measure to make sure the measure is correct. So this is the intuition. This is the intuition about the formula, how we calculate the growth financed by vendors and suppliers for long-term assets. So let's look at the test, the empirical test, to see whether it works. So you can see that. So you can see that. So you can see that the operating asset growth, operating growth, predicts the future earnings. So basically, asset growth financed by vendor and suppliers predict the future earnings. And then what we see here is the financing growth. The growth financed by debt and equity is negatively predicting future asset earnings. So you guys see the difference, right? That's why this is good growth, this is bad growth. The growth financed by vendors predict future positive earnings. The growth financed by the equity and the debt predict negative future earnings. You see the good growth and negative growth. Okay, let's look at these two variables. This is suppliers short-term financing. This is government tax financing. You see that it doesn't load. It doesn't load. Does that confirm what I just claimed? Does that confirm what I just claimed? Earlier I was saying, suppliers short-term financing may be useless because this is short-term. So the data speaks themselves, right? When you predict the future earnings, it does not have a significant relationship with future earnings. Same as the tax financing. The tax financing also do not have significant relation with the future earnings. So that kind of confirms what I said from the early slides. That's why we need to take out the short-term financing from suppliers and the tax financing from the government. So to summarize, what do we learn from this table? What do we learn from the table is we have a good growth. The good growth is asset growth financed by vendors and suppliers and customers for long-term stuff. We have bad growth. Bad growth is the growth financed by the equity and the debt. And we have the vendor short-term financing. It doesn't matter. It doesn't matter. It predicts nothing. We have a tax financing. It predicts nothing as well. So that's why we have a good growth here, and we have a bad growth here. That's the first test. We want to make sure theory-wise, we test the theory, make sure that's correct. And we'll keep moving. We want to do the short-term test. We want to do the short-term test to see if it also generates returns. So what we found is when we use these to predict the annual return, the return is about 4%. So the good growth can predict 4% of annual return in next year. And how about short window? This is a 12 days return. I forgot, this is 12 days or 3 days. Anyway, this is short window return. This is about 1%. So in the several days window, you have 1% return. For annual window, you have a 4% return. So you see that what's comfortable? What comfortable is most of the return are actually from the short window. And I told you guys why we like a short window return. Think about it. You buy and hold the stock for 3 days. Comparing you buy and hold the stock for 200 trading days. Which one you would prefer? I would prefer buy and hold for 3 days. For 3 days, there's less events, there's less drama, there's less risk. If I hold for 200 trading days, a lot of things can happen. We may have another COVID-19 coming in the next 200 days. So you never know, right? You never know. The longer you hold, the more risky events may happen in the future. So that's why we prefer we can obtain the return from shorter window rather than the annual window. So you can see that the results showing that for the annual window, most of the return, it's 1 divided by 4 is 25%. So what does that mean? That means if you trade the stock around the earnings announcement, you can get 25% of return from your annual buy and hold. So that means 25% of return can be realized just by buy and hold around earnings announcement, the 3 days around earnings announcement. That's beautiful. That's beautiful because it's less risky. It's less risky. So so this is the things we just talked about. In the last class, I keep emphasizing how to predict the signal you have here. Is something you know, other people don't know. How do you know the signal, the operating growth can predict earnings? And this is the signal you know about, other people don't know about. I said 2 steps. The first step is you use that to predict the future earnings. It's positive. And the second step is you use it to predict the future returns. If everybody know this one can predict the future earnings, you won't see the operating growth predict the future stock returns, because we can see that the operating growth can predict future stock returns. That means you are the one of the few guys know about this. A lot of people do not know about this. So when do they know? They know about this among the buy and hold in the following year. They know this in the following earnings announcement. That's why you can buy the stock based on the operating growth. And when do you realize the returns? You realize the returns when the future earnings is announced. You realize the return when you buy and hold for the subsequent year. So because you are the one of people know the signal, so you know the signal ahead of other market. So that's why you can buy the signal and use that to predict the future stock returns. But in case you don't see the significance here, so in case the operating growth cannot predict the future stock returns, that means what you know also is known by other people. Okay, that means what you know is also known by other people. So that's the I'm keeping emphasizing this again and again, so you guys understand how we form the trading strategy, how to test whether the one strategy is tradable or not. Yeah, and you can see that after control for other variables, so the signal, the positive growth predicts 4% annual return, and the positive growth predict 1% return around earnings announcement. And we like the percentage. The 1 divided by 4 is 25%. We like that. We like that. This is empirically, it supports this is a good growth. Supports this is good growth. And yeah, this is stuff. So another thing is we want to show this is not driven by risk. You know, I keep emphasizing that you have to make sure the 4% and 1% It's tradable profit, it's not risk. It's tradable profit, not risk. We have to do a lot of stuff to make sure that's the case. So the first approach we do is adjust for risk. So you can adjust for size, you can adjust for the book to market, you can adjust momentum, liquidity, you can adjust for a lot of risk factors. So the idea here is once you adjust for all these risk factors, if we still have an alpha there, that means this is not driven by those risk. Even it's driven by some tradable profit. That's one way we are doing that. But you know that there's one problem is you only can adjust risk. Maybe there's like 1 million risk there. You don't even know. That's what I discussed the first class, right? So how do you make sure? How do you know you can adjust for risk? You don't even know. For example, COVID-19. Do you even know about COVID-19? That's not on your list. That's not on your list. So how do you make sure the profit, the 4% and 1%, it's still tradable? Even you adjust for stuff, for risk, you don't even think about. So we have several ways. I will discuss. We have several ways to do that. The first is short-term window. We just discussed, right? The short-term window, if you have a high percentage return from short window, that's more confident. That gives us more confidence. In our case, it's 1% over 4%, so 25% from short window. It's very strong pattern that the profit can be obtained in 3 days around the earnings announcement. So short window can give you guys the confidence. This is tradable profit. It's not risk because there's less risky event among the short window. That's one way you do it. Another way we do that is look at the declining pattern. So let's look at the table here. Let's look at table here. We adjust for risk. We can do that, adjust for risk for short window. So let's look at the table together. So look at it. The positive growth can predict the following earnings announcement. And for the next following earnings announcement, it's a weaker result. For the third earnings announcement, no result. Fourth earnings announcement, no result. So what does that mean? That means the investors can, so that means, okay, let's go back to the story. The story is, you know the operating growth, it's a good signal. Other people doesn't know. That's your assumption. So when you see in the following earnings announcement, you realize 0.4% return. That means other people takes 3 months to know what you know. And then in the next earnings announcement, we have a returns. That means in the following 3 months, people are still learning what you know. What do you know? But in the 9 months, there's no return. That means what? Means in the next 6 months, people already get what you know. So in the 9 months, there's no return. There's no return here. And in the 12 months, there's no returns here. So that means what? It means it takes 6 months. It takes 6 months for investors to know what you know. It takes 6 months for investors to understand operating growth. It's a good signal, can predict the future positive returns and earnings. That's why we want to see a decline pattern. That's why it is a decline pattern, because decline pattern consistent with the story we have. When you see a decline pattern, that's like I said, that means the investors takes 6 months to learn what you know. Takes 6 months to know the operating growth. It's a good signal to predict the future. In the 9 months, there's no return. The reason because no return, because they already know that. It only takes 6 months for them to learn. That's the story here. So let's look at the other case. What if it's significant here, significant here, significant here, significant? What if the whole 4 quarters, the subsequent quarters are all significant? What does that mean? That means the investors takes forever to know what you know. It does not make sense. It doesn't make sense. If you see the significance continuing in the future. That means this is not about information you have. That's about the risk. There's a risk there. The risk keep predicting the premium in the future significant. That's the story behind. So that's why we want to see a declining pattern here. That's one declining pattern here. When we see a declining pattern, that means you know something other investors do not know, and it takes 6 months for investors to know that this is a good growth. If you see a declining pattern. However, if you don't see a declining pattern, if you see significance over the 4 quarters, you cannot interpret as investors take 1 year or take forever to know what you know. It's impossible. Investors will know what you know eventually. If you see the significance over the future quarters, that means it's not about the information you have. It's about the risk. It's about the risk continuing associated with future risk returns, premiums. So that's why we want to see a declining pattern over the future quarters, over future years. Just to put it simply, if you see the declining pattern over future periods, that's good. That means you know something other people doesn't know. If it's continuing to be significant, that's a risk. That's considered a risk. So this is the ways how we distinguish between the tradable profit and risk. So you can adjust for the size, momentum, blah blah blah, a lot of things. One approach, you can do the short window. You can see the declining pattern. That's all a method we use to make sure this is a tradable profit, not risk. We have to be serious, right? This is about money. This is money. You want to make sure the profit you gain, it's profit, not just random gambling. You don't want to gambling. As a finance students, you don't want to gambling. What you want is rigorous data analytics and generate tradable profit. Okay, and also what else you can do? What else you can do to so what else you can do to show this is a profit, not risk? There's other things you can do to show this is a profit, not risk. One thing is you can look at the analysts. You can look at whether stock analysts also do not understand the pattern you see, because you want to show that you want to prove there's something you know other people don't know. So how do you observe other people don't know? One group you can observe is stock analysts. So you can see that if stock analysts do not react to the information you have, that means there's a good chance the market didn't know something you don't know. Does it make sense? Let me repeat it one more time. So the idea here is you want to prove you know some information other people don't know. For example, you want to prove operating growth is a good growth for the future. You want to prove that's the information you know. Other people have not realized yet. So how do you observe other people? One group of people you can observe is stock analysts. So you can look at the stock analyst forecast. If stock analysts do not incorporate the information you have into their forecast, that means you are knowing something analysts do not know. If you are knowing something analysts do not know, there's a good chance you're knowing something the whole market do not know. That's the idea. Okay, that's the idea, to show this is the trading profit, not risk. This is one approach. This is one approach. Another approach, what you do is, you show by the story. What's the story? The story we have is when vendors have more information about the firms, they will know the firms well, and they will not allow the firms to do bad growth. So another test that you can do is, if the vendor knows the firm more, would you see stronger positive return in the future? If the vendors know the firm less, would you see less positive returns in the future? So another way you can test is, you can test your theory using different scenarios, because the story is what? The story is because the vendors know the firms, the vendors do not allow the firm to do bad growth. So we can test that by looking at how much the vendor know about the firm. If the vendor knows about the firm a lot, then we should see stronger positive growth. Because if the vendor knows the firm a lot, if the vendor finance the firm, that means this is good growth, really good growth. But if the vendor doesn't know the firm that much, just know a little bit, this kind of vendor financing maybe just very weak positive, very weak positive. So these are the different ways. These are the different ways we can rule out whether this is tradable for profit or the risk. So not just by short-term window, not just by declining pattern. This is what we talk about the slides. So we introduce two more ways to rule out risk. One way is look at whether the information you know, whether do analysts know that. If the information you know, analysts do not know about it, there's a good chance all other people doesn't know. This is approach one. The second approach is you look at whether when vendors have more information about a firm, did you see a stronger positive growth? If the vendors know a little bit about the firm, did you see a weaker positive growth? So that's another way to test whether this is risk-driven or luck-driven or profit-driven. So this is different ways you can test. You can differently test. So the bottom line here is trading strategy is a no joke. We don't want just you touch your head and saying, okay, I can make money. You don't want to do that, okay? You have to do a very rigorous way to rule out this one work. You can generate a profit. It's not by luck. It's not gambling. It's not you are just too overconfident about self. So the bottom line here is form a trading strategy is a no joke. You have to do a lot of rigorous check on whether the profit you claim is driven by the real tradable profit or something else you don't even know about. So you have to do a very rigorous data analytics to make sure this is an implementable trading strategy. And this is very important. Okay, this is very important. I want you guys to be aware of when you guys work in when you can ask speakers come in. The speaker he's more of a fundamental guy. He's more of a fundamental guy. So but you go to industry, you can see that they do very rigorous tests on the trading profit. This is money. You know, this is money rolling there. You don't want to abuse this investment. Your reputation is there. So this is the strategy I want you guys to be aware of. And I want to open up